Historians will tell you the first options trade took place around 332 BC when Greek philosopher Thales of Miletus brought the rights of an olive, this olive farm, just before that year's harvest. From a modern day perspective, the first trade occurred in 1973 when the first listed options were traded on the floor of the Chicago Board of Options Exchange, or the CBOE. That day, just 16 stocks traded through instruments like calls and strike prices. Today, tens of millions of these contracts traded daily. Options can be used to generate income like any other trading strategy, but they're also seen as an effective way to hedge against risk. Options trading volumes can also give you a sense of the direction of a stock.
And for example, last year, after Tesla announced its first price cuts, put contracts, that's a bearish indicator. That's you buy the rate essentially to sell the stock, were the most traded instruments on the EV maker's shares in the aftermath. The price of those contracts also rocketed almost 250% at one stage during the fervor. And zero-day-to-expiry contracts are the latest vehicle innovation, you might say, in this space that are capturing attention, with the likes of JP Morgan's Marko Kolanovic calling it a Volmageddon risk. Now you can track that kind of volatility more closely with the arrival of the VIX one-day index that measures those short-term moves in the market or tries to capture them. So all of that said, how do you play this space most effectively? There are a lot of choices, from pre-Socratic philosophers to some modern-day wisdom. Let's bring in Bob Lang, Explosive Options founder, and this segment is sponsored by Tasty Trade. Bob, that was a lot of history to go into for options to bring us to today. But bottom line, this latest zero-day-to-expiry invention, if you will, in the market, and now the index that's trying to capture that has really, caused consternation among some, certainly has shaken up the world of options. What's the big sort of takeaway that investors should have from this?
Well, these zero days to expiration, which means if you traded something this morning after the market opened, it expires today. Like there was the S&P 500 spiders, the QQQs, they all have daily expirations now. And you can basically get into a trade and not have to worry about the time decay factor that is always present with these options. But the thing about these zero DTE options is create a lot of volatility in the markets. And creating a lot of volatility means not necessarily that markets are going to go down, but necessarily it's the movement, right? When volatility increases, we see large moves up and down. But most of us as risk-averse investors, I think every single one of us, would love to have a risk-free investment without having any money at risk. Basically, we're risk-averse, and when we start seeing big movements up and down, especially down, we start getting fearful and nervous and worried and scared, and we end up having to pull our money out, and that's when you get larger declines. That's why there's a funny phrase that says markets take the elevator up, but going down, it's like taking the window, going out the window. So
yes,
it's the same.
I've heard versions of that one also. So is this new index then, and have these new 0 days to expiry options, have they created the volatility, or are they a reflection of volatility in the market, do you think?
I think it's both. I think really it's a reflection of people's attitudes for risk appetite at a certain moment in time. I think these last 3 to 4 months, we've seen markets up fairly strong. Actually, after Friday's close, if we get a positive close in April, it'll be 3 positive months out of 4 in 2023. So people are starting to get excited and interested about taking risk again. It's about risk appetite. And I think so that in and of itself feeds into creating a lot of volatility in these markets, because look, market makers on the other side of the trade who are selling these instruments to people don't really want to have that risk on, and they're obviously have to take the other side of a trade and so forth. It's just creating a lot more volume. Now, as far as the CBOE is concerned, when they see a market opportunity there, they go ahead and take advantage of it. They started these weekly options, they started these zero DDT options, and now obviously the new one that you mentioned about the VIX one-day options. It's as long as there's somebody who wants to trade it, they're going to put a product out there.
Is there an optimal time during the earnings season to really be looking at volatility and using that as some type of instrument to trade within your portfolio, knowing that there are times of the earnings season that are more volatile than others just based upon the types of companies that are reporting?
Yeah, good question, Brad. So I think as we head into earnings season, what ends up happening is we see short-term options, especially ones that expire slightly after earnings come out, they become very expensive. And what we try to do is we looked at that and say, well, historically, stocks will move very, very large after earnings. Look at this morning, you see Boeing is up close to 5% this morning on a good earnings report, right? So the options that expire this coming Friday were priced in for that. So maybe even priced in more. So we look at historical volatilities and historical moves to try and determine if the stock option is priced out of range or not. So what we try to do is try to sell the short-term option and maybe go long a month or so, maybe out into May or June. So sell this one that's coming in on Friday. Take the risk of the fact that maybe the stock may not move that much, and let that time decay work for you in your favor.
And not just sort of the timing the options correctly, but also in earnings season, how do you pick which companies you want to actually trade the options for? Because some of them are very crowded, some of them are very expensive, to your point. So is there sort of a screen or criteria that you're using?
Yeah, so I basically looking at historical moves on some of these stocks. Last week we had Tesla came out with earnings, and you noted that one a moment ago. And the options were extremely expensive, and you can screen for some of these stocks, but just looking at the stocks in general with their regular volatility moves on a historical basis, you can look at the past 20 days, past 30 days of volatility in these stocks, and see how they move and compare that movement to what is the expected move. It's the implied move that really captures people's imaginations. Like, well, I mean, if I want to get in on Meta tonight, or I want to get on an Amazon tomorrow, what is that expected move going to be? And boy, if it's only 6 or 7%, Meta's trading at what, 210? If it's only going to go up about $12 or $13, what if it goes up 30? I want to capture that. So that's pretty much the screen that I kind of look at.
Bob, great to have you here with us, breaking down all things options today, especially with relation to volatility as well. Thanks so much. That is the options founder, explosive options founder, Bob Lang. And our options pit segment is sponsored by Tasty Trade. We'll be right back.